Hello and welcome to STA 330 Actuarial Statistics. I'm Eunice Frimpon from Accra Technical University, and today we begin our exciting journey into a new topic, insurance statistics. Whether you are studying to become an actuary, a financial analyst, or just someone interested in understanding how insurance works, this lecture will provide a solid foundation. So what exactly is insurance? Insurance is a contractual agreement where the insurer agrees to compensate the insured for specific types of losses in exchange for a premium. It is built on the idea of risk transfer. Instead of bearing the full cost of an uncertain loss yourself, you pay a premium and transfer that risk to a company, an insurer, who is better equipped to handle it financially. Insurance is also based on risk pooling. That means many people pay premiums into a common pool, and when someone experiences a loss, they are compensated from that pool. This allows many to protect the few, making insurance a fair and powerful financial tool. So why is insurance important? Think of it this way. Life is uncertain. Illness, accidents, fire, natural disasters, these can happen at any time. Insurance offers a safety net, reducing the financial impact of such events. It also promotes economic stability by helping people recover from losses. It also gives confidence. That is, it takes the risk in business and life away. And it encourages social cooperation because the financial burden is shared across a population. Insurance has a rich history. It began in ancient civilization with informal risk-sharing practices. And over time, these evolved into standardized contracts, regulated industries, and a wide range of modern insurance products. Today, you find insurance for almost every area of life, from health and property to events and income. Let's look at the types of insurance we commonly encounter. There is life insurance, health insurance, property insurance, liability insurance, contingency insurance, and other types like annuities, disability, and workers' compensation. Now let's quickly go through these things, these types of insurance. We start with life insurance. Life insurance provides financial support to your loved ones when you pass away or when you die. There are various forms. There is term life, which covers a specific time period. Then there is also whole life insurance, which provides lifetime coverage with a cash value. And there is universal life. It offers flexible premiums and savings features. Now, this type of insurance brings peace of mind, especially for families who have dependents. Now, to distinguish term life from whole life, for term life, the insurance will cover your life for a specific period of time. So if the insurance is covering you for 20 years from the start of the contract, within that 20 years, if you die, then your beneficiaries will be supported financially. But if the 20 years pass and you are still alive, then the contract has ended. But for whole life insurance, your life is covered for your entire life. So any time at all that you died, your beneficiaries are given financial support. Now let's look at health insurance. Health insurance helps cover medical expenses due to illness or injury. It's essential because medical costs can be high and unpredictable. It promotes access to quality healthcare, and it reduces the financial stress during illness. Now we look at property insurance. Property insurance protects physical assets, that is your home, your car, or a business. It typically covers fire, so it covers these assets, or it protects these assets from the cost involved from losses resulting from fire, theft, natural disasters, and accidents. So natural disasters like flood or storms. Imagine losing your house to a fire. Property insurance ensures you don't have to start over from scratch financially. There is liability insurance. It covers you when you are legally responsible for injury or damage to someone else. That is a third party. So this is important for drivers, business owners, and professionals like doctors or contractors. It protects you from lawsuits and compensation claims. Now, for contingency insurance, it covers unexpected disruptions like events cancellation or business interruptions. And other key types include annuities, that is providing regular income in retirement; disability insurance, that is replaces your income if you become unable to work; and then we also have workers' compensation, which covers employees injured on the job. So these are the other types of insurance: annuities, disability insurance, and workers' compensation insurance. The question now is, what is the purpose of insurance? The main purpose of insurance is risk management. It reduces uncertainty by shifting the financial burden from the individual to the insured. From the individual, that is the insured, to the insurer. Now, it also gives you peace of mind, and it gives you business continuity and a sense of financial security. So if you have insurance covering some aspects of your assets or your life, you know that if anything happens to this thing, or if anything happens to me, the financial burden that comes with that event that has occurred is taken care of by an insurer. What are the key functions of insurance? Let's summarize the 4 key functions of insurance. We have risk transfer. The financial burden of a loss is moved from the insured to the insurer. The second one is that there is risk pooling. So many contribute to a fund so that the few who suffer the losses are supported. Then there is also financial protection, where insurance helps people and businesses recover after unexpected events. Then finally, we have wealth creation. Some insurance products help build savings or investment returns. Example, if you buy an educational fund policy for your child, an educational fund is an insurance policy where you make some premium payments over a period of time until your child reaches a certain age. For example, when they are ready to go to college or university. So once they reach that stage, you can go for the money and pay for your child's tuition fees for their college. So this insurance is 7 building savings or investments over a period of time. Every insurance policy has some common components. Let's explore them. We have the premium. Now, this is the payments you make to keep the policy active. It could be monthly, quarterly, or yearly. The second one is policy limit. This is the maximum amount the insurer will pay for a claim. So if there is a policy limit to an insurance policy, regardless of how much the loss is, once the insurer will pay only up to that policy limit. So if the loss is, let's say you suffer a car accident or the car has an accident and the total loss from that accident is 50,000 cedis. Now, if the insurance policy covering that car has a policy limit of 25,000, the insurer will pay only 25,000, even though the total loss is 50,000, because of the policy limit of 25,000. So the policy limit is the maximum amount of money that the insurer will pay, or that is covered by the loss. Then we also have deductible. This is the amount the insured must pay out of pocket before the insurer pays anything else. So for deductible, once there is a deductible in an insurance policy, the insured, the policyholder, will have to pay that first. Then if the loss exceeds the deductible, the insurer will pay the balance of the loss after the deductible. So let's take a simple example. If your medical bill is 1,000 cedis and your deductible is 200, then you will pay the 200 and then the insurer will pay the balance of 800. Now, there are some other terms you may need to know. We have policy term. Now, policy term is the length of time the policy covers. We also have renewability, whether and how you can extend the policy after it ends. So first of all, can you extend the policy? And secondly, how can you extend the policy? Then finally, we have cancellation clause. Now the terms, and this is the terms under which the policy can be terminated by either party. So we set, before the policy starts, we decide on these conditions or on these terms, the insured can terminate the contract or the insurer can terminate the contract. Finally, three important aspects of insurance are claims process. Now, this is about how to file a claim and receive your benefits. The claim is when you have suffered the loss for which you bought an insurance and the loss happens, you need to go to the insurer and make a claim. You tell them that you have suffered the loss. So you are registering that the loss has happened and you want them to do what they said they would do when the loss happens. That is to give you the cover. So that is a claim. A claim is going to your insurer when the loss has happened to make a statement that a loss has happened and demand for your benefits. And the claims process is how to file and document the claims. Now, we have also insurable interest. You can only insure something if you stand to suffer financially from its loss. So if you can go and insure your car, but you cannot go and insure your parents' car in your name because the car is not for you, it is for someone else or a friend's car. So you must have an interest in the property or in the life that you are insuring. If you don't have any interest in it, you cannot insure. So you cannot go and insure someone's dad. You can insure your dad's life. You cannot insure someone's dad's life because you have an interest in your dad, but you don't have an interest in someone else's dad's life. Then we also have exclusions. These are things the policy does not cover, such as certain medical conditions, fraud, or intentional damage. If you intentionally crash your car, you will not be covered if you go and make a claim. And if you cannot go and insure fraud, like you want to do a financial deal that is not legal, it's illegal, and you want to take an insurance for that, you cannot take an insurance for that. You also cannot take an insurance for certain kind of medical conditions. I want you to think about what kind of medical conditions or research on what kind of medical conditions that you cannot get an insurance cover for. So always read the fine print to know what's included and what is not. Whenever you walk into an insurance company or you talk to an insurer, possibly for an insurance cover, make sure you ask for the policy document and read every single line of the policy document so that you don't sign on to something and then when the loss happens and you go to make your claim, you are told that unfortunately we cannot cover this because these terms were excluded in the policy documents. So one key thing to note, always read the policy document of every insurance you are considering taking. And this brings us to the end of our introduction to insurance statistics. To recap, you've learned what insurance is, why it matters, the different types and purposes of insurance, and the key components of an insurance policy. If you found this video helpful, please give it a thumbs up, share with a friend or a classmate. I look forward to seeing you in our next lecture. Take care and keep learning.